Good morning. It's Mary Ellen McGonigal, and this is the MEM Edge show. This is the show where we put you in front of stocks that are poised to outperform the broader markets. And we do quite a bit of work, not only with individual stocks, but with broader market, bigger picture, industry group, sector work, with all, again, an eye toward getting you in front of where the outperformance is and where the projected outperformance may be going forward. So let's go ahead and get started. I am going to provide you with a bit of a background as to what we are going to be covering here today. And first up, we are going to be taking a look at the broader markets. I always like to start with a quick review, testing the health of the broader markets, again, to give you an eye toward making sure that the backdrop is healthy, that you are in a period where the markets are going to support you going in and purchasing individual stocks. And then also where the strength is now, we'll take a look at where that outperformance is, again, with an eye toward going forward. Earnings setups, we're at the very, very tail end of earnings season here. There are still a tad few more names that are going to be reporting. So a couple of stocks that are setting up that are worth keeping an eye on. They're due to report this week that could very well outpace the broader markets. And then also a newer segment, which stock would you rather own? We're going to compare two stocks in a strong industry group. I'll tell you which stock of the two I favor and why, and we'll see if they pan out. So let's go ahead and get started. Here's a weekly view. We're looking at the S&P 500. And for those of you following the markets closely, you'll know that last week the S&P did go ahead and hit a new high in price. So we did finally break out above this 2018 late January, early February peak. So we broke above that 2,800. So super bullish. And we closed above there, indicating that we have now recovered from that correction. So the backdrop in the broader markets is super healthy, uptrend firmly in place. I like to overlay simple moving averages when I'm using and looking at broader market indices. Here we're using SPX for the S&P. The red line is your 50-day simple moving average, very clearly in an uptrend. The blue is your 200-day simple moving average, again in an uptrend. We can see that the index has found life, if you will, above this upward trending simple moving average. So the backdrop on the S&P certainly is very healthy. Quickly, here's the NASDAQ. This is a daily view of the NASDAQ composite, and I'm sure you're quite familiar that the NASDAQ is filled with quite a number of technology stocks, faster growing names. And we can see here prior to, this is as of the close on Friday. It had a very strong day on Friday, but there was a period close to about 2 weeks where the NASDAQ was waffling. Technology stocks were struggling. There was a sense that potentially we could maybe be losing our leadership, but the NASDAQ did come back and super strong. It hit a new high, and that is wonderful news for the broader markets. The NASDAQ has been a leadership industry group. It was the first to hit a new high out of the correction. We can see this new high here and yet again, and the index is up double digits year to date, so clearly a leading index. So we do have that backdrop as far as the broader markets being healthy. Let's go ahead over to StockCharts.com and we can take a quick peek at this candle glance. This is the ability for you to compare side by side 12 different, you can do stocks. In this case, I've done industry groups, and it's giving a 2-month snapshot of these various industry groups. What I've done here is gone ahead and put in the largest sector industry groupings, as well as the NASDAQ, S&P, the Russell 2000, and some other ETFs that have really been on the move lately, and that would be the semiconductors, SOXX, as well as iBuy, which is the retail sector. That's been doing quite well. And what we can do once you input the various ticker symbols, you would do that down here at the very bottom. Then you can overlay an indicator that will help you decipher where the strength is within this grouping. So what I've done is added an RSI, and that is a relative strength indicator. And so from there, you can go ahead and sort that by descending. So it's going to provide us with a snapshot of the strongest sector or stock, depending on what you go ahead and put in. And so up here in the upper left-hand side is the strongest all the way down to the weakest. But let's go ahead and take a look. Healthcare XLV is the ticker symbol, and that ETF within the S&P is currently the strongest. And we can see that healthcare really has been in a very, very nice uptrend, and it really is quite a leadership group. For those of you that may read some of the blogs on StockCharts.com, my recent post there under Top Advisor Corner goes into great detail as to why healthcare is doing well. There are many very, very substantial and sound reasons why healthcare is at the forefront now. A lot of policies in place, a lot of new drugs, new innovations going on there. So healthcare is currently your strongest area in the markets, and that's followed by consumer cyclicals. We've seen a number of stocks in the retail space, consumer-driven, that are powering to new highs, strong earnings. We have an economic backdrop that is supporting that, with unemployment at an 18-year low, consumer confidence 18-year high. They are going to be reporting consumer confidence this week, but the cyclicals are second as far as relative strength to these other performers. We talked about technology coming back into favor, and tech is having another nice day today. And so let's go ahead and drill down a little bit further to these areas in the lower quartile. Consumer staples had been outperforming, but it fell out of favor a bit last week. It was the worst performing sector last week, but it seems to be finding support. But today, the focus is on financials. Financial stocks overall have been underperforming the broader markets, and you can see where it's languishing here. But today, they are up 1.5%. So we'll go ahead and drill down into some of those stocks in a moment. But looking at those financials, let's go ahead and compare that to the healthcare. And you can see a significant difference where the financials are languishing down here, but healthcare is charging to new highs. So that is a good snapshot of where the current strength is in the broader markets. And from there, there are a number of very, very useful tools within StockCharts to go ahead and drill down just a bit further. So let's go ahead to what is called Sector Summary, accessible on that first page. Talked about financials, and they're up almost 1.5% today. So what you can do from here quite simply is left click onto that sector name, and it will provide you initially with a sort by sub-industry grouping as far as what is driving these financial stocks today. And you can see what are called investment services. This was a big sub-industry group last week. And let's go ahead and drill down, and I'll explain why that very well may be the case. So initially, what we are seeing are a number of trading-related financial, and there was news out about Morgan Stanley and what they are doing in the way of offering free trading. And so that was very big news. But what we can see just quite quickly is that Morgan Stanley really is not a healthy stock. It is in a clear-cut downtrend. It is trading below your key simple moving averages. So this is not a stock that I would favor or suggest that you take a look or get involved with. But what you can do here once you're in a sub-industry group is go ahead and sort it by that scooter, SCTR, and that is going to provide you with a really good feel for the stronger names. The higher that number, the better. And it is a technical analysis primarily driven in well, it's not an index, but it is a wonderful tool as far as what information that it provides you with. It's a bit of a longer term one. So from there, what you can do is go ahead and drill down and take a peek using that snapshot as far as which names within that are faring a bit better. But let's go ahead and take a look at some of the banks that are up today. That industry group is up about 1.5%. So we can then pull up those stocks, go ahead and sort it by that scooter, and you can see that the best performer is SVB Financial. SIVB is the ticker symbol for that. And let's take a quick look at this stock, and we can see relative to the financial sector that SIVB is indeed outperforming. This is a stock that I'm quite familiar with. It used to be called Silicon Valley Bank, and they renamed. They are very cutting edge as far as their lending to a lot of these faster growing tech stock companies, and we can see that it's not overly dynamic, but it certainly is setting up to break out of this bigger base. A lot of my work, I'm looking at patterns. I want to see stocks that are poised to break out of these saucer type bases. Your RSI is positive, and your MACD is in positive territory. So these are all very handy, healthy tools as far as ways for you to get in front of not only where the strength is, but how you can capitalize on that and potentially get in front of individual stocks. So let's go ahead. I wanted to take a look. We talked about XLK. That is the technology sector charging to new highs. The NASDAQ is benefiting from that. But underlying the technology sector, of course, are many sub-industry groupings. And among those are the semiconductor stocks. We talked about those coming back into favor. But I'm going to take a look at another sub-industry group, and that is software stocks. And these software stocks have really been super powerful as far as the relative outperformance of those underlying stocks within the technology. So we can see this is ADSK, this is Autodesk. They reported last week, shot to new highs. So let's take a look at some of the sub-industry groupings within software. This first is an ETF, SKYY, and it's for cloud computing. And so cloud computing stocks have been very, very dynamic, very powerful. We can see they're poised to break out potentially to a new high. Another sub-industry group within software is HACK is the ticker, and that's the cybersecurity ETF. And cybersecurity stocks outperformed quite strongly last week. They were up 4.5%. And we can see that the cybersecurity, it is carrying into this week. So I mentioned to you that we were going to take a look at two stocks within this strong sub-industry group, these cybersecurity stocks. So let's go back to our presentation here. And here is another chart, another look at that cybersecurity ETF into the close last Friday. And what I've done is chosen two stocks within that cybersecurity software space. And the first, on the left side, we have Palo Alto Networks, PANW. This is the largest of the cybersecurity stocks that are within that industry grouping. And then on the right, we have Checkpoint, CHKP. So both of these are daily price charts. And let's begin with the very basics. What I'm doing here is an overview and a review. You have found that sub-industry group within technology that's outperforming. You'd like to uncover a stock that will benefit from that strength. So here are two stocks side by side. Checkpoint is very well known within the cybersecurity space. So quite simply, I've overlaid, this is taking us from April to current into the close last Friday. So Palo Alto, we can see last week, it broke out of a 10-week base. And we talk about bases. This is a saucer type base. It broke out and it did so on very big volume. That's quite constructive technically. Your RSI up on the top, it's above that dashed line. So it is positive. And your MACD has had a positive crossover here. So quite a bit going on that is constructive with Palo Alto. Let's go ahead and move over to Checkpoint Technologies. And this stock has not quite broken out, but it does appear poised to break out of this 1 month base. Your RSI is positive. And your MACD is in positive territory. It's above this net zero, but it appears to be drifting downward. It's not quite as dynamic as Palo Alto. So let's drill down a bit further and get a little more informed about these two stocks. So the first thing that we can note here with Palo Alto, I've done a little research here. Palo Alto is due to report earnings September 6th. So that is going to be upcoming. They have not reported yet. So we like to know that because earnings from my work is going to be the primary driver of a stock as far as when you are looking for outperformance. Some other information about Palo Alto is their largest quarterly jump in earnings and sales came at their last release. They released earnings back on June 4th. So what we are looking at would be back in this period. And at that point in time, they did have the biggest quarterly jump in not only earnings, but also in sales. Their earnings were 62% greater than the prior year. So it was their best showing since 2016. So that is quite constructive. And then also, I like to take a look at sponsorship. You want to see our institutions in a particular stock. And in fact, with Palo Alto, they had the largest jump in sponsorship in over a year. They had improved sponsorship by over 10%. So in other words, institutions are coming in, they're noticing the stock, supporting it. Let's go ahead over to Checkpoint. They came in and they actually already reported July 25th. So that is going to be this gap up right here. So the company did come in with pretty good numbers. Actually, they were only single digit, 6% as far as their earnings increase over that same quarter a year ago. So they had single digit, not only earnings, but also in sales. So quite lackluster in that regard. And then as far as an increase in sponsorship, the most recent reported, a very nominal, maybe about 8 new funds came in and bought Checkpoint. So I think quite clearly, based just on the recent information that I've shown you, my pick outstanding would be Palo Alto as having the potential to outpace not only the broader markets, but certainly Checkpoint Technologies. And one key factor here is, for me, would be this MACD, the dynamic down here. It's just coming out into positive territory. Your RSI is trending upward. And we have a lot more going on, not only with the technicals on the chart, but dynamically, they have quite a bit more growth side going on ahead of them. So that's a quick peek at two stocks, again, that are in a very strong area of the broader markets. Let's go ahead. I also wanted to review a phenomenon that's been going on here with earnings season. We are at the tail end, but there is a phenomenon going on that you can still take advantage of. So of the stocks that have reported, we're close to 5,000 companies have reported, over 400 of them have gapped up after earnings. They've come in with strong earnings. The stock has gapped up. I'm going to show you an example. This is PETQ, Pet IQ. It's a smaller billion-dollar company that came in. They reported on August 14th. So you can see this gap up. They gapped up 10% on earnings, which was quite substantial coming out of the space. But subsequent to that, we're looking at a daily price chart. The stock has gone up 20% more. So we're up a total of 30% post earnings. Take a look at that huge volume. And then also the fact that you can marry that with constructive technical characteristics as well. Let's take a look at another. There are any number of these. This is Advanced Auto Parts. AAP is the ticker symbol. They also reported August 14th. The stock gapped up 8%. They came in with numbers that were 6% above estimates, but subsequent to that gap up, a lot of people think they may have missed the move. The stock, in fact, did add on another 10%, and it does appear to have more upside ahead of it. This is a 10-day simple moving average that I like to overlay on these faster moving stocks. You want to find support at that upward trending moving average as it moves forward. Here's another example, better known. This is Nordstrom, JWMN. And this stock, they reported on August 17th, and the stock right here gapped up 13% and is up even more. It's up 5% post that gap up. So again, and not all stocks are acting in such a positive fashion. Here is Network Appliances, NTAP, and they actually came in with very good numbers. They reported on August 16th, showing 73% earnings growth, but the stock really did not gap up. You want to get in front of those that have gapped up. For those that would like more information, you can go to my website, meminvestmentresearch.com, and under trading courses, I'm actually offering a recently developed course on how to capitalize on these stocks that gap up. It's going to really provide you with a lot of insights and also provide you with some setups for this week for stocks that are due to report. So I would urge you to go ahead and take a look at that. Now, we mentioned that there are companies that are due to report, a couple of setups for this week and stocks that you can take a look at. It's rather slim pickings. We are at the tail end of earnings season, but let's take a look at one of a couple of names that we can review. This is Tiffany & Company, and it is, of course, a jewelry $16 billion company. They're due to report earnings tomorrow, and what I like to look for in looking at candidates of stocks that are at the very least worth putting on your radar screen is a couple of factors. One is you want to see the earnings estimates being revised up going into earnings. That historically does put is favorable. It has been found to be favorable if analysts are raising estimates going into earnings, and that is the case here with Tiffany. And then also I like to take a look at how the stock performed their most recent couple of quarters. So here is the last time that Tiffany did come out and report earnings. The stock gapped up 23% on earnings and then subsequently did go up higher. So we do have two factors that make this interesting to go ahead and put it on your radar screen. However, technically the stock is no doubt faltering. We have the RSI below this net neutral in negative territory, and your MACD is now below zero. So technically the company is not sound. I would not be a buyer going into earnings because of this. The technical poor characteristics are going to outweigh the two positive characteristics that I mentioned. I would not be a buyer going into earnings. However, I would put it on your radar because historically, post gap up, you can see it has been able to advance further. Let's take a look at another company that will be reporting this week. This is HEI is the ticker symbol. It's Heiko Corp. This is a military defense related stock, and it really has done well. I put out a biweekly newsletter. This stock has been on our list as a suggested holdings for quite some time. I'm pulling up a weekly. So we've had this on our list for a super long time. It's been a real outperformer. But what I wanted to point out to you is that, again, they are due to report after the close today. And you can see that the stock is behaving positively. Certainly technically, your RSI and your MACD are positive above their net neutral lines. And earnings estimates are being revised upward, certainly for 2019. So we've seen an increase in military spending, but there is another subsidiary within HEICO that has caught people's eye, and that is they do have a 3D printing facility and a subsidiary, and that has people excited primarily because these 3D printing companies seem to be coming back into favor. I'm going to pull up a couple of stocks. This is 3D Systems. DDD is the ticker symbol, and they reported a couple of weeks ago. Take a look at that gap up, huge gap up. And the stock, this is akin to what I was mentioning before, that it has remained and continued to trend higher. Analysts are excited about the prospects. SSYS is another large 3D printing company. They also reported gapped up and are continuing to expand higher. So that brings us back to HEICO, HEI. You like to see other industry groups that a company is a part of coming in with positive earnings as well. It's telling you that the market dynamics out there are constructive and that you can pay attention. BBY, this is a last name that we'll go through. It's Best Buy. They are due to report. And what I wanted to point out here is while it is positive, as far as the RSI and the MACD going into their earnings report. Last quarter, the company did report positive earnings, but the stock dropped subsequent to that. So again, I would not be a buyer going into earnings just based on history, how they tend to trade. But this stock also has earnings estimates being revised upward. Consumer spending, consumer sales are very clearly in an uptrend. And so I would put Best Buy on your radar as well. And then a couple of other things I wanted to cover. There are stocks in the news today with talk of Mexico potentially having positive outcome as far as trade possibilities. A couple of the industrial stocks are doing well today because of that news. So I wanted to take a look at one of the heavyweight names within industrials. We can start out by taking a quick peek at the group graph, and you can see industrials are gapping up 1% today on the positive trade news. So we'll drill down and take a look at Caterpillar. And what I wanted to briefly spend time on is the fact that the stock is up 2.64% today, but it is not healthy. Caterpillar is trading below these key simple moving averages. Now, what I also wanted to point out to you is the characteristics that you would need to see to turn positive, because we have the RSI just going up into positive territory, MACD trending up, but it's below these simple moving averages. And I do need to leave it at that. But before this stock turns positive, it is going to have to get up above this 200-day simple moving average, but it is on its way. So I will leave it at that. Happy trading. Always welcome to hear from you. MEMinvestmentresearch.com. Contact me and I'll be happy to expand upon anything we reviewed today.